Hello, this is the Banking and Credit Systems episode number 1. Topic: How banks work. What happens to your money? This is distributed by Meridian Finance Solutions. Well, why does knowing about banking matter? Well, understanding how banks work can help you make smarter financial decisions. First, your deposits aren't just sitting untouched. Banks can use them in ways that impact you directly. Second, banks can help you grow your money through interest, but they can also profit from your deposits. And third, once you understand the relationship between banking, credit, and you can also avoid unnecessary fees and choose accounts that give you the most value. So, step one, depositing money. Let's start at the beginning. When you deposit money, it shows up in your account balance, but it's not all kept as physical cash in the bank. Most of it exists as a digital record. Only a fraction is held in actual bills. Once you deposit it, your money becomes a part of the bank's overall pool of funds that they can use for other purchases and other purposes. So, step two, fractional reserve banking. Here's where it gets interesting. Banks operate under something called fractional reserve banking. That means that they only keep a portion of deposits as reserves, which is an amount required by law, and they loan out the rest to individuals, businesses, or they themselves can invest it elsewhere. The reserve requirement ensures that there's enough cash available for normal withdrawals, and when banks make loans with your deposits, they themselves can earn interest from borrowers, and that interest is their main profit source. This system fuels economic activity. Why? Well, because loans help businesses expand, people buy homes, and communities grow. But it also requires careful risk management to prevent problems. If the bank isn't careful with this, then they can often not be able to fulfill the demands of many people who have put their money within the bank. So, step three, understanding how banks actually make money. So, the first way is charging interest on loans. It's pretty simple. When you get a loan from the bank, they often charge you an interest. So, over time, as you pay back that loan, the bank will be making money from that. Since many people have to get loans on things, banks often make a lot of money from that. Then there is charging fees for services like ATM withdrawals, overdrafts, or account maintenance. These fees are not too much, but as it compounds over time, they will get a lot of fees. Third is investing in financial markets or government securities. This is not as much from a lot of the other methods, but it is a reliable source of income. And finally, there is the offering of premium services for a fee, such as safe deposit boxes and wealth management. Every product that they offer, from credit cards to savings account, is part of their business model. So, step four, what can you get in return? In exchange for letting them use your deposits, banks give you a secure place to store your money, access to banking services like debit cards, online banking, and bill pay, and the chance to earn interest on certain accounts like savings or CDs. And the key here is to pick the accounts that give you the best balance between convenience, safety, and earnings. So, the safety net is FDIC insurance. One reason people trust banks is because of this. It protects your deposits if the bank fails, covering up to 250,000 per depositor per insured bank. It applies to checkings, savings, and some investment accounts, but not to crypto, bonds, or stocks. And what this FDIC insurance does is that it gives consumers the confidence that their money is safe. After all, if you weren't sure that your money would be safe in a certain bank, why would you want to put your money in that bank? With the FDIC insurance, it makes sure that no matter what, you'll always have at least some of that money available. So let's see a numbers example with with a $1,000 deposit. So you deposit that much into your savings account. The bank keeps $100 in reserves, assuming a 10% reserve rate ratio, and then it loans out 900 to a business. The business spends that $900, and the person who receives it deposits it into another bank. That bank keeps out 10% and loans out the rest again. This money will keep on repeating, multiplying the money moving through the economy. Your $1,000 deposit, therefore, it doesn't just sit there. It's actively working out behind the scenes, and it will keep the money flowing out through the entire economy. Now, let's look at slide 9, common misconceptions. So the first one is that banks will keep all your money in a vault. Well, actually, most of it is digital and in circulation. Like we've seen before, banks often loan that money out, so they only keep a fraction of that amount of money in a vault. The second one is my money disappears when loaned out. That's actually false because your balance stays the same. The bank just doesn't hold it out all as cash. Banks only benefit themselves. No, they can benefit you too, especially if you choose the right products. And an extra one is that all accounts earn interest. Well, in reality, many checking accounts don't. So it's worth checking your options. So for your challenge, this week, you should try to become a bank detective. So check your bank's interest rate for both savings and checking accounts. Compare and find out their fees and look at one other bank. Ask yourself, is my bank helping my money grow or is it just storing? So in the end, banks are a cornerstone of the financial system, but they're also businesses. Knowing what happens to your money once it's deposited helps you take out the advantage of the benefits while also avoiding unnecessary costs. Thank you for listening.